Hello everyone, and welcome for another weekly analysis covering the macro and crypto markets. So last week, the main dominant narratives in the macro landscape were government shutdown risk. We also have escalating war and also new additional tariffs. And then we had a stronger than expected economic data that caused a crash or a flash crash in the crypto market and one of the biggest liquidations event that we've seen in the crypto market. The crypto sentiment also last week went sour, especially when coin investors and crypto investors in general saw gold at all-time high, while the crypto market was lagging behind. And this definitely lowered sentiment across the whole cryptoverse. And as you know, narrative stands to follow price action and not the other way around. And that's why the main dominant narratives that were basically affecting the crypto market were what I just mentioned across the macro landscape, and that is mainly fear of a government shutdown that might cause a sell-off in the crypto market and escalating war across the globe, mainly in Europe and in the Middle East. So for the new members, let me just walk you through really quickly before we dive into our analysis, how we basically analyze the market. So we follow a top-down approach where we basically look at the macro landscape, try to identify the monetary policy, the fiscal policy, and liquidity. And from that, we then move into the crypto market and see where we are in the 4-year crypto cycle and try to analyze if the 4-year cycle is still ongoing or something else is changing right now, especially with the fact that the whole industry right now is becoming more and more regulated. And based on those two analyses, financial markets and macro, then crypto-specific market, then we come up with a final assessment for how we should be positioned for our own portfolios. So now let me dive into our analysis, starting off with the macro landscape, specifically monetary policy. Fed Chair Powell described current rates as modestly restrictive, maintaining optionality for future cuts while acknowledging policy has moved toward neutral. So last week, Jerome Powell had a speech, and in his speech, they also had some economic projections, and they were just looking at the economy and trying to see what the economic indicators and data is basically telling them. Powell said that the current rates are modestly restrictive. This is one of the highlights of his speech. He also said that despite 25 basis point cut in September, bringing rates to 4.25%, the Fed is taking a cautious stance, balancing downside risk to employment against upside risk to near-term inflation. So they are in a very tight place right now. They don't want to be tightening too much in order not to cause a weakening in the economy and the rise in unemployment rate, and at the same time they don't want to be easing too much in order not to cause inflation to spike up again. So they are more reacting to economic data rather than being proactive in order not to tilt the balance in one way. Powell also attributed recent inflation pressure to tariffs, characterizing it as one-time level shift likely to spread over several quarters rather than sustained inflation. And he also said that long-run inflation expectations remain anchored near 2%, which gives the Fed confidence despite current PCE readings that came out above target. As for the fiscal policy, so we see that the government shutdown risk right now is escalating. Trump also reportedly preparing to instruct agencies to begin layoffs, especially if the shutdown materialize. Federal employee buyout payments from January expire September 30th. Shortly after Trump went into office, they established the Doge, and Doge went on a layoff spree basically to downsize the whole government. In order for them to do so, they had to basically make buyout payments for federal employees that were basically losing their jobs. And they gave them enough time until September 30 for them to actually find a new job. So any employees who haven't found work will file for unemployment, foreshadowing higher future unemployment rates. So in the event that some of these employees could not find new jobs, then expect that the unemployment rate in the next reading, not this one, not the one that's coming out on this Friday, but rather next month in October, to show higher unemployment rates than actually expected. On top of that, we also see that the TGA, and that is the Treasury General Account, right now back above 800 billion. So as you can see here, we are right now sitting at 805 billion. And here is a very good question. Is the liquidity drain over already? Because the target for the Treasury General Account was to basically reach above 800. And usually this is the range that they want to stay in. And it is somewhere between 750 all the way to 900 billion. Currently, we are at 804 billion, and there was a rise of 500 billion since July 16. So that's 2 months and a half. The Treasury General account sucked $500 billion worth of liquidity from the market into its own account. So definitely that had some negative effect on liquidity in the whole financial system, and this could be one of the reasons why Bitcoin is lagging behind gold, because definitely Bitcoin is way more liquid and way more sensitive to liquidity than gold or any other asset for that matter. If you have read the research paper that was done by Lynn Alden, in it she speaks about the fact that Bitcoin is the best barometer for liquidity. It has an 83% correlation to M2 money supply. And even though right now we're talking about the Treasury General account, nevertheless, the correlation between Bitcoin and liquidity is very tight. And the fact that the Treasury General account or the US government has been removing liquidity from the system into its coffers to a tune of 500 billion in 2.5 months, that's a substantial amount, then definitely that had some negative effect on liquidity and in turn on BTC. And that could be the reason, it's not sure, it could be the reason why BTC has been lagging. And hopefully by now, with the fact that the Treasury General account is already at a level where Besant and the Trump administration wanted to be, right now we can have some relief for liquidity, and soon enough, definitely this Treasury General account will be redeployed into the economy, further pushing liquidity into the system, which hopefully will usher in the altcoin season that we have been waiting for. It will coincide with Q4 as well, and Q4 tends to be very good for crypto asset prices. We're going to keep monitoring this metric week on week in order for us to see how that might affect the prices. But personally, I do believe that once this Treasury General account starts getting drained again, we should see a positive momentum for asset prices. Moving on to the economic landscape. So the economic picture remains murky with roughly 50% probability of either direction. So also we see that there is stagflationary signals emerging, and this was very obvious by the economic outlook and the speech that was made by Jerome Powell on September 23. And for the ones that would really like to read all of this, here you go. This is the economic outlook. You can go ahead and read it. It's available in the show notes. For now, we're just going to go through it point by point in order not to make this very long. What basically the Federal Reserve said during their speech is that growth has moderated to approximately 1.5% annualized in the first half of 2025. On top of that, they said that the labor market is showing clear softening. We see that inflation is ticking higher above target, although this increase is not alarming enough to derail Fed cuts, but there is upward pressure. So what do we see here? We see that there is upward pressure on inflation, and there are signs of a weakening economy. So this means that we are in a stagflationary environment where, again, you have weakening economy and rising inflation, putting the Federal Reserve in a very difficult spot. And in my opinion, the most likely outcome out of this would be yield curve control, where the economy will weaken to a point where the Federal Reserve will have to step in and ease monetary policy to push markets and reduce unemployment rate again, but that will ignite inflation. So in order for them to be able to fight inflation, they will have to do yield curve control. The fact that interest rates on long duration debt went higher after the Federal Reserve cut interest rates is telling us that market participants are pricing in future inflation, and easing monetary policy will drive more inflation. So in that case, in order for the Federal Reserve to tame interest rates and not let them go to levels that are so high that might bankrupt the whole economy and the US government, then they will have to put a ceiling on these yields. And in order for them to do so, they will have to do something called yield curve control, where they basically go on the open market and start buying securities and government debt in order to push yield down. And if this happens, this means that they are effectively doing quantitative easing, but the massive quantitative easing, meaning currency debasement, meaning asset prices will benefit from this. So equities, crypto, risk on assets will definitely perform very well. It's because it's not something fundamental to these asset classes, but rather because the denominator, or because the currency is being devalued. We clearly see here that the de-dollarization trend is accelerating, and it's also coming from the US allies, not only their competitors. All of this definitely caused gold to soar to all-time high amid as well government shutdown risk and de-dollarization. So we see that gold is right now going parabolic, and right now we are sitting at 3,828. The good thing is that usually from a historical perspective, Bitcoin tends to follow. So when gold is breaking out, Bitcoin tends to consolidate. And once gold starts consolidating, BTC rip higher and catches up to gold. We see that also fear and greed index plummeted into fear territory on September 26, and this is a very positive sign of sentiment reset. Liquidity walls currently sitting at 114 and 118K, while ETH is sitting at 4.2K. So if we look, these are the liquidation walls. We see that we have a liquidation wall for BTC at 114K, and then we have another one sitting at 118, as you can see here. As for Ethereum, it is currently the big wall that Ethereum have is currently sitting at 4.2K with more pain to the upside, further telling us that the price is most likely to move upward rather than to the downside. So this is the ISM. This is a very good predictor of the manufacturing business cycle. So what you guys can see here and what Raoul Pal basically talks about is that businesses tend to refinance every 4 years. And this basically drives liquidity cycles. So when they refinance, and especially when you see moves in the ISM like these parabolic moves here, the crypto market tends to follow as well. So this is one cycle started in 2001 all the way to 2005. So that's 4 years. As you can see, we went up and down. Another cycle, we went up and all the way down into the 2008 crisis. Another cycle started 2008 all the way to 2012. Up and down, 2012 to 2016, up and down, 2016 to 2020, up and down, and then we have 2020 all the way to 2024. This is up and down in my opinion, but Raoul Pal don't believe this. He believes that this cycle is not over yet, and the acceleration in the ISM will most likely come somewhere between Q4 2025, potentially Q1, Q2 2026, and this is why he believes that this crypto cycle might be a bit more extended than the usual 4-year cycle that we've seen. There is definitely merit to what he's saying, but who knows? We're going to keep monitoring this metric and we'll definitely keep updating you in order for us to see the correlation, what's happening in the crypto market, narratives, and combine all of that into one final assessment. Bitcoin dominance has been rising also recently. As you can see, Ethereum dominance has been falling. Solana dominance also has been falling with 2 close long signs, which is definitely very bad. Top 10 dominance is definitely had recently some sell-off, but right now has resumed its uptrend. But you can clearly see here that 4 moving averages are curling up and to the right, and a clear sign that we are in a macro bullish trend for top 10 dominance. As for low cap dominance, this is medium to low cap coins. We are inside of the cloud with more signs of an exhaustion, as you can see here. And the macro and the slowest moving average is flat at the moment, as you can see here, it's flat. So the top 10 dominance is stronger, which is also telling us that from a money movement perspective, we are also getting closer to the end of the cycle, because we clearly see here by the dominance charts that I just showed you that capital moved from Bitcoin into Ethereum first, then into Solana, then into top 10. This is where it's residing at the moment. Next, it will fall into low cap coins. We expect this to happen in October, November, potentially maximum December, before everything roll over and the cycle is over. But obviously, this cycle is slightly different than any other cycle. So that might not be the case exactly. There might definitely be different things that play out here. We're going to keep on monitoring the charts on a weekly basis in order for us to see what is the most likely outcome. Is this an extended cycle further into 2026? Is this a super cycle, or are we going to top similar to every single cycle before this one? We'll definitely keep on updating you on what we see in the charts and what I believe is the most likely outcome. So this was the roundup for you guys for last week. Thank you so much for tuning in, and I'll see you in the next one. Everything shared in this recording is for educational purposes only and should not be considered financial advice. The strategies, insights, and opinions expressed here are meant to help you understand the market and build your own perspective, but ultimately, all investment decisions are your responsibility. Digital assets are highly volatile and carry significant risk. Always conduct your own research, seek independent advice if needed, and never invest more than you are willing to lose. Freedom capital does not guarantee outcomes, and past performance is not indicative of future results.